Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
In terms of, what orange-blue lines below the ISE chart and how is volatility being measured? Well, the volatility, let me answer that second question there, and then we'll get back to John. The volatility is being measured by the trend itself, because realize a trend in and of itself is a volatile event. It's imbalance, okay? It's a volatile event in and of itself, just as a non-trending market is a non-volatile event. There's boredom, there's confusion, there's less volatility. But when there's an imbalance, and the scales are tipping one way or the other, that trend begins, there's more volatility associated with that. You're going to pay more for engaging in a call when the market's heading up. You're going to pay more for buying that put in a down market, okay? Think about it. If the market's heading up and everybody knows it, in other words, these three lines are pointing upwards between what I call 12 to 2 o'clock. Everybody knows the market's moving higher. The premium on your call is going to be more expensive, okay? Now, I want to look at a call because I'm not trying to pick a top. I'm not trying to pick a top, so I'm not going to be looking at puts as the market's going higher. Sure, a put's going to be a little bit cheaper, right? Looking for an option to take advantage of movement lower, but if the market's trending up higher, do I really want to be getting into a put just because it's cheaper? Do I really want to be a contrarian just because I can? No, I want to move. I want to work with the trend. I want to play the trend. I want that, what do they say? Let the trend be your friend. When's the best time to get into this market? Well, I acknowledge that sometimes we're not going to be able to take advantage of the short period of time the market's bored or confused, again, in that distribution or accumulation market. Sometimes we won't even get that. Take a look at this chart. We went straight from mark down to mark up. Very little time in transition. So what is our other opportunity? Well, that's where the wave comes back into play. Every time within the context of this Euro-US dollar daily, again, the EUU for our symbol on our ISE, every time the market pulls back, okay, we have an overall uptrend, as I can see by the angle of these three lines. Okay, but every time we pull back, the reason I'm comfortable buying calls into these pullbacks is because the wave, I know the difference between a reversal and simply a correction. Okay, just because the market comes down and trades lower within an uptrend does not make it a reversal. Okay, the line in the sand as far as reversals versus corrections for me visually is the support of the wave. So as long as the wave is able to support prices on these pullbacks, I'm comfortable buying a call into these pullbacks. Because what am I trying to take advantage of? Let me tell you. You guys probably know this. I'm not telling you, this is no newsflash. Buying an option, a call option during this part of the market as it's moving up, or during this part of the market when it's moving down is a very different experience as far as what you are paying. If I think the overall trend of the market is moving higher, I want to take advantage of these moments when prices pull back into the wave. You can see some very distinct opportunities. This is what I want to take advantage of. The reason I call it shopping is I'm looking for a value. I'm looking for a deal. I'm working with the overall trend. I know the difference between a reversal and a correction. I want to pay for time. I want to pay for my strike price, but I do not want to pay for volatility. I want to benefit from volatility. When I am selling my option back into the market, realizing hopefully a profit, what I'm hoping to benefit from is volatility. Okay? So again, I don't want to leave myself so little time that I run out of, that the time decay erodes the value of my option. So I need to give myself enough time to let the strategy, again, play out. And I want to be at a strike price where, again, I mentioned before I buy options out of the money. if the market moves with volatility towards my strike price, even if it doesn't reach it, the value of my option is going to go up because of volatility. That's where you get to benefit from volatility. So you don't want to pay for it because that's the very element you're hoping to profit from. Okay? So again, give myself time and then put myself at a point in the market where I don't have to be, again, in the money because I'm looking to pay as little as possible for this option on this correction. So don't feel the need to buy an in-the-money option, but what you could do, use simple tools, use psychological levels. Maybe you're going to use a Fibonacci level. Now, you could very easily pull a Fibonacci in a chart like this and say, okay, maybe I'll look at a 161.8, or maybe I'll even add in some other levels. I think we could look at some other Fibonacci levels, like let's add them in right now. I could get a 1.272 level. Okay. So I could look at some Fibonacci retracement and extension level and buy a strike using Fibonacci. For those of you that don't like Fibonacci, maybe you'll use pivots. For those of you that don't use pivots, maybe you'll use psychological levels. I know 5,000 was a level a lot of people felt the euro was going for. Well, I want to buy that 5,000 call now. But when it's way down here, and if I feel the market is going to head up toward that level, even if it doesn't touch it, if I buy a call option on this pullback, even with the out-of-the-money option, it's going to work in my favor. Okay, because again, I'm trying to take advantage of volatility. People who usually need strike prices that are in the money are paying for volatility. So they need even more volatility. They need prices to go beyond their strike or into their strike to see a profit. What I'm telling you is try to position yourself in a different way. Okay? So let me take a quick look at the chat window here. Okay, just bear with me here. As far as shorter-term time frames, they're usually not my favorite for options trading, but thank you for your question. For 15, 30, 60-minute charts, on a 15-minute chart, I'm really not looking at much more than about 3 to 5 days. That's about all I need. It's a very short-term intraday psychology. For a 30-minute chart, 1 to 2 weeks. Again, a fairly short intraday psychology. And for a 60-minute chart, it's 2 weeks. Again, for 15, it's about 3 to 5 days. For 30-minute, it's about 1 to 2 weeks. And for a 60-minute, it's about 2 weeks. And thank you for that question. Again, hold on for 1 second. I'm going to go grab my bottle of water here. All right, thanks for that. Okay, so hopefully that clears that up. As far as location, as far as how far out of the money do I buy, I don't want to be so ridiculous that I'm reaching a level that is unrealistic, but to be quite frank, I'd say about 80% of the time, when I'm playing options, they never have to be in the money. They just need to move at the direction. Okay? Again, what I'm looking to do is buy that option when the volatility is low. Again, during that accumulation and distribution cycle, when the market is moving sideways according to the 3 lines of my wave, the 34 EMA high, low, and close, or I'm looking to buy on a pullback within an uptrend, or a bounce in a downtrend. Let's not forget that. I could be buying puts in this downtrend on bounces up on corrections. Okay, so it goes both ways. So what I'm trying to do is eliminate as much as possible the pricing of volatility within my premium that I'm going to pay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.